Growing olives in California can be challenging and risky. How can Federal Multi-Peril Crop Insurance, or MPCI, help secure your farm's bottom line? This yield-based program is offered and reinsured by the USDA Risk Management Agency. RMA, in turn, approves private insurers to issue policies, adjust claims, and pay losses to the grower. To make it easier for growers, there's no difference in coverage or premiums between carriers. The policy helps should your farm suffer crop yield losses due to damage from natural causes such as freeze, hail, excess heat, high winds, insects, disease, or wildlife. The actual production history, or APH, crop policy is based on your prior harvested production. Two types of olives may be insured: table olives for processing, measured in tons per acre; oil varieties measured in gallons per acre. Trees must meet minimum age and production requirement, including standard density planting of 100 trees per acre or less are insurable at 5 years old. High density plantings of 100 trees per acre or greater can be insured at 4 years old. Trees must produce at least 2.5 tons per acre or 100 gallons per acre in one of the last 3 years to be insurable. The policy is a 2-year period. The grower insures 2 consecutive years with the same coverage level for both years. Farmers wishing to buy a policy must do so before the sales closing date of January 31st. The grower can select coverage levels beginning at catastrophic and up to 75% of their approved historical average production. How does it work? Pablo farms 100 acres of table olives in Corning, California. With the help of Dominic, his crop insurance professional, he decides to insure 70% of the orchard's past yield history. The orchard's average past production is 5 tons per acre. Regrettably, the orchard suffers a crop loss due to frost in the spring when the fruit's blooming. Pablo notifies Dominic, his agent, within 72 hours of the event happening. The carrier sends their adjuster to inspect the damage. The harvested crop was only 1 ton per acre. Since his APH was 5 tons per acre at 70% coverage, that's a guarantee of 3.5 tons per acre. The 3.5 ton per acre minus actual production of 1 ton leaves a deficiency of 2.5 tons per acre. The RMA predetermined value of the crop is $625 per ton. 2.5 tons multiplied by $625 per ton multiplied by 100 acres equals a total payable loss of $156,250. This helps Pablo to cover the fixed costs invested in crop and keeping the family farm going. Federal crop insurance is subsidized and backed by the USDA to keep rates affordable. The farmer pays a portion of the premium, the government pays the rest. The first decision is to find a specialist in crop insurance who understands the program and the risks you face in farming. At Golden Pacific Crop Insurance, we have 2 decades of experience in crop insurance and still farm our own crops as well. We know what you face out there with ever-increasing food safety regulations, water costs, and labor issues. Our job is to make your crop insurance program simplified. Give us a call and see how easy it is to put this important program to work for you. It's more affordable than you may think. Call us at 559-825-CROP, that's 2767, or by email at dfino@goldenpacificcrop.com.